Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic expenses. In this question, you will look into the rent expense ledger account. You will understand the differences between rent payable and prepaid rent and discuss two accounting theories. You can see the question on the left hand side of your screen, and on the right hand side, we have got all the workings which I'll go through and explain to you step by step. With that being said, let's begin. Linda runs a photo studio. Her business has a financial year ending 31 December. The following ledger account has been prepared. So here you can see we are given the rent expense ledger account, and you can see that we are starting the year 1 January 2021 with a current liability, which is rent payable. And because it is a liability, we are showing the opening balance on the credit column, because liabilities by default must have an opening balance on the credit column, and also when it increases we credit them, which ultimately gives us a net balance of 800 credit. Okay, then we have got a cash at bank transaction at 28 June 2021 where we have paid rent using funds available in our bank account. So when we pay rent, the correct way to journalize it would be to debit the rent account and to credit the cash at bank account, because we have used our funds available in the bank account to pay the rent. So as we understand, in the journal entry, the rent account is being debited, and it is being debited by $9,400, and the relevant cross-reference for the account we include in the particulars column is the cash at bank account, which goes down in value when we pay for this rent. So what happens? So we have got 9,400 debit, and previously we had 800 credit. So obviously there is a mismatch between debits and credits where we have more debits than credits. So what we do is find the difference between 9,400 and 800, which gives us 8,600 with a net balance of debit. Okay. Then for the year ended 31 December 2021, we have included two other transactions here. So starting with the prepaid rent, which is a current asset, and this refers to rent payment in advance. This rent payment is actually for the next financial year, but because we are in the current financial year and we have prepaid it, it is a current asset. All assets by default must have an opening balance on the debit side when we record it in the ledger account, which means when it increases, we debit it. But this balance for asset is at the end of the year on 31 December 2021, which is the closing balance, and the closing balance must be credited. So therefore, the prepaid rent is $700 included in the credit column. So previously we had a net balance of 8,600 debit, which now gets reduced by 700. So we now have $7,900 debit. Okay. What we also know is that we ultimately want to end up with a net balance of zero for any expense and income ledger accounts, mainly because we want to start a new financial period with a zero balance for expense and income, so that we can correctly match the relevant expenses against the income and determine the profit accurately. So therefore what we are doing is that to offset the entire $7,900 debit we had at the end of previous transaction, we have to show that we are transferring as part of the closing entry to the income summary account at 31 December 2021 an amount of $7,900, which refers to the actual rent expense we have incurred for the financial year starting 1 January 2021 and ending 31 December 2021. So when that 7,900 credit gets offset against 7,900 debit, what we end up with ultimately is a net balance of zero, which is what you can see here. All right. Now the requirement in part A is to state the meaning of each of the following terms. So we are starting with the rent payable. So we understand rent payable is a current liability, and the reason it is a current liability is because we have a present obligation for rent expense, which we have incurred in the previous financial year. So in the previous financial year ending 31 December 2020, we had got rent expense, and that amount was $800, as we can see in the ledger account first entry, right? So we understand we have a present obligation now to pay this off. And the reason it is a present obligation is because we want to make sure that we're paying it off fully in the year 2021. And that is also as part of the definition of current liability, which refers to obligation that we pay within the 12 months, okay? And then you have got prepaid rent, which we understand is a current asset, and this simply refers to payment for rent in advance. This payment is made in the current financial year, but this payment is actually applicable for expense, which we expect to incur in the next financial year. So we know next financial year we're going to have some rent costs. So what we are doing this year is we are just paying our landlord altogether for the next year as well. So what happens now is that we've got a current asset because we expect economic benefits to be consumed in the future, as a result of which the expense will be incurred. Okay? All right, so let's look into part B. Name and explain the accounting theory that is applied when a business accounts for prepayments. Now, we could talk about two accounting theories. So let's start with the accrual theory. Accrual theory simply states that revenue is recorded as we earn it, not necessarily when cash is received, and expense is recorded as we incur it, not necessarily when cash is paid. Okay? And how that applies to the prepaid rent in this case is that we understand that we have paid for rent in advance for the next financial year, but in this current financial year, we cannot classify it as an expense because we haven't incurred it or we haven't consumed the economic benefits. We understand we paid the cash in advance, but we haven't really used the benefits that come with this payment for rent. Okay? We are only to consume these benefits in the next financial year starting 1 January 2022. So you could discuss about accrual theory and then write your statements as how I have described for full marks. If you want to go with the matching theory, we understand matching theory simply states that income or any revenue is always going to be matched against the expense that we incur to produce that income. All right. So whatever revenues we generate and whatever income we earn during a financial year, we obviously will have some expenses that we incur along the way because that's how businesses work, right? So in order to accurately determine a correct profit, we need to subtract the differences between revenues earned. So we need to look for the differences between revenues earned and expenses incurred, okay? So what will that give us is an accurate profit. So the key words here are earned and incurred. So with regards to this example where we have got a prepaid rent, again, the $700 payment is for the next financial year, which means we cannot really match that excess payment against the income which we have earned this year because that rent is only going to be used by us in the next financial year to help us move forward with our business operations, right? So therefore, you could also discuss about the matching theory and simply first mention the definition. And after that, you relate it to the example which we have got in our case and just write a simple statement mentioning why the prepayment is applicable in this case and why we shouldn't classify the $700 prepaid rent as an expense. Okay? Now, part C, state and explain of not including prepaid rent, okay? Not including prepaid rent when accounting for rent expense on the following. Profit for the year and current assets. So if we fail to record prepaid rent, which we understand is a current asset, what we will end up doing is overstating our expenses because we would have recorded that excess payment of $700 as part of our rent expense, which we have actually incurred this year, right? So therefore, the mistake would be that we would end up overstating our expenses. And when expenses go up, our profits will go down, obviously because of the reciprocal nature between profit and expenses. And then because we are not recording our assets correctly, which is the prepaid rent, we are understating our current assets as well simultaneously. Okay? All right. So that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. And check our programs which we are running in 2026 for POA 7087 and POA 7086 students. Classes start 10th of January and it's going to help you ace your exams end of year in 2026. With that being said, I'll conclude today's lesson and I'll see you in the next one.